This isn't a rally. It's a system fracture. Silver just broke $100, and instead of cooling off, it sped up. That's the contradiction. The higher it goes, the less resistance it seems to face. And if you're watching this thinking it's just another hot trade, here's why it matters to you. When price discovery turns parabolic, your currency is the thing getting repriced. Here's the hard detail. Silver moved from $90 to $100 in just 10 days. But the move from $20 to $30 took 145 days. That's not normal volatility. That's velocity. And market observers are already projecting a jump from $100 to $150 in weeks, not months. But here's the part nobody is saying out loud. When markets don't consolidate at psychological levels, it's not confidence. It's panic. And if panic is driving the bid, the next thing that breaks won't be silver. It'll be the mechanism behind it. Most people think this story is about a metal crossing a round number. But that's not the real event. The real event is what $100 does to behavior, to liquidity, and to the plumbing underneath the market. Silver crossing that line doesn't just change the chart. It changes the time scale. Because the moment $100 breaks, price increments stop behaving like steps. They behave like slides. The move from $90 to $100 took 10 days. That compression matters because it suggests the market is no longer negotiating with sellers. It's overrunning them. And that's why projections like $100 to $150 in weeks even enter the conversation. Not as hype, as a mechanical possibility when momentum becomes its own fuel. Now watch how fast this escalates. Historically, resistance levels exist to slow buyers down. But in a melt-up dynamic, resistance becomes irrelevant because capital inflows arrive faster than supply can react. The market shifts from, is this expensive, to can I still get any? So here's the framing question you should be asking. If silver can detach from its old constraints this quickly, what else is about to detach with it? The strongest argument that this breakout is structural isn't the number on the screen. It's what's happening off-screen. The supply chain is starting to seize, not at the mine, but in the middle layer where the market normally breathes. Refiners and secondary flow. Here's the concrete detail. Major refiners have stopped buying junk silver and sterling silver, or they're delaying payments anywhere from 10 days to 3 months. That single change detonates the business model of bullion dealers overnight. Because dealers don't survive on static inventory. They survive on velocity. They buy, refine, sell, restock. Rinse, wash, repeat. And now, that loop is snapping. Notice what they didn't fix. Refiners will still take pure 0.999 fine 100-ounce bars and kilos. But alloyed metal is becoming functionally illiquid at the wholesale level, even while spot prints record highs. That's a bifurcation. One form of silver moves instantly. Another form freezes in place. And the moment that happens, the pricing mechanism stops representing reality for everyone. But here's the part nobody is saying out loud. When the system can't process metal fast enough, scarcity isn't theoretical. It becomes operational. Now watch the psychology flip. The moment silver breached $100, it didn't just attract buyers. It pulled in an entirely new universe of people who have no history with this market. Not because they understand silver, because they understand one thing: the price is running. Dealers describe it as a frenzy, a wave of retail demand driven by pure momentum and fear of missing out. That's the Veblen effect in real time, where higher prices don't reduce demand, they amplify it. The price becomes the advertisement. And suddenly, silver isn't being bought for value. It's being bought for participation. Here's the scene-based detail that matters. Dealers say they're buying 6 figures of inventory daily, and the showcases still stay empty. That means retail offtake is stripping supply faster than it can be replenished. Premiums don't slow it down. Record nominal prices don't slow it down. The buyer's brain has shifted from "should I" to "how late am I?" And there's a second force tightening the float: long-term holders. The people who held through years of ridicule see $100 as vindication, not an exit. They don't sell into strength. They hold harder. This is where the story flips. If the crowd is buying and the veterans refuse to sell, the market isn't climbing stairs anymore. It's climbing air. Here's where the signal turns sovereign. Because the market isn't just being driven by retail emotion. It's being validated by an institution that normally doesn't chase hype: the United States Mint. The Mint effectively marked a new floor in the public mind by repricing its products far above spot. Proof silver eagles that used to sit in the mid-90s were pushed to over $170 per ounce, roughly double the spot price at the time the decision was made. That's not a normal premium adjustment. That's a forward-looking wager built into the price tag. Here's why that detail changes everything. The Mint has a captive audience: subscription buyers, collectors who don't blink the way traders do. That gives it pricing power the broader market eventually has to acknowledge. And when a sovereign-linked entity prices silver as if higher levels are inevitable, it conditions the entire ecosystem for upside. It's not just selling a coin, it's anchoring a new valuation. Notice what they didn't do. They didn't price for a return to $50. They priced as if the currency's purchasing power against the metal has already been permanently impaired. The paper spot price becomes a reference point, not the truth. And once the official storefront starts treating $100 as the foundation, not the peak, the crowd stops asking, "Is this a top?" They start asking, "What's the next number?" Now the part that makes this breakout feel irreversible: the short trade is collapsing in real time. Not because short sellers got brave, because they disappeared. Here's the concrete contradiction. Reports say there are millions of shares available for borrowing at low fees, implying it should be easy to bet against this move. And yet, as silver crosses $100, the market is seeing almost no one willing to step in and short it. In the words being used on the ground, it's pure insanity to even try. That absence is a signal. Because short sellers aren't just speculators. They're the counterweight that normally caps rallies. They supply gravity. They force consolidation. They create the pullback. And right now, gravity is missing. Look at the speed. A $10 move in roughly a week changes the survival math of anyone leaning against it. That kind of tempo turns a short position into a ticking clock. If there are still shorts out there, they're not holding convictions. They're being forced out, liquidated, squeezed. The moment that starts, price doesn't climb because buyers are strong. Price climbs because sellers are trapped. But here's the part nobody wants to admit. When the entities that historically suppress silver stop fighting the tape, the market doesn't revert to normal. It rewrites the rules. Now stack the pressure, because this isn't happening in one lane. Silver isn't just breaking out on a chart. It's getting pulled, squeezed, and re-rated from multiple directions at once. And the speed is the warning. First, the physical pipeline is clogging. Refiners are delaying payments. Secondary metal is turning illiquid, and dealers can't keep showcases stocked. That means supply isn't responding to price the way it's supposed to. Second, the psychology is going vertical. New buyers are flooding in with zero education and maximum urgency. That's when price stops being a number and becomes a countdown. Third, the suppressing forces are vanishing. The short side isn't providing resistance. It's providing fuel. Because the faster the move, the more it punishes anyone trying to lean against it. But here's the part nobody is connecting fast enough. When these three layers hit at the same time, physical constraint, crowd frenzy, and short capitulation, you don't get a normal rally. You get a runaway auction. And a runaway auction doesn't pause because it's overbought. It pauses only when something breaks. The refiner, the dealer, the exchange, the confidence. So ask the only question that matters now. What happens if this continues? Now bring it back to your life, because this isn't just about people trading metals. This is about what a $100 silver market does to ordinary decisions, your savings, your costs, your sense of what's stable. When silver moves like this, it signals something deeper. People aren't buying because they expect a normal return. They're buying because they don't trust the system to stay calm. And when that psychology spreads, it doesn't stay in the metals corner. It bleeds into everything: prices, wages, lending, even the way people hold cash. Here's the everyday consequence. When physical supply is tight and retail demand strips shelves, the gap between spot price and what you can actually buy becomes reality. You stop asking what the market says silver is worth. You start asking what it costs to get it in your hand. That's a different world. And there's another layer: the behavior shift. Long-term holders see $100 as vindication. New buyers see it as a starting gun. Both groups tighten the float at the same time. That pushes premiums, makes availability unpredictable, and turns simple purchases into timing games. If this feels familiar, say so in the comments. Because the scary part isn't the price spike itself. It's how quickly the definition of normal gets rewritten around you. Here's the systemic mechanism that makes this smarter than a hype cycle. What you're watching is the collapse of legacy correlations, the old relationships that used to keep markets in check. And once those relationships break, price stops behaving like an asset. It starts behaving like a referendum on trust. One of the biggest cracks is global arbitrage. A persistent premium is showing up in Eastern markets, with the Shanghai Futures Exchange trading silver higher than the West, about $10 above U.S. pricing, with prices reported above 110 as U.S. markets breach 100. That gap isn't a curiosity, it's a vacuum. It pulls physical inventory toward the higher bid, draining supply from wherever the price is lagging. But here's why that detail changes everything. If price discovery shifts eastward, Western spot prices stop leading. They start chasing. The official quote becomes a delayed reflection of where the real demand is clearing. Now, layer in de-dollarization pressure. Central banks are diversifying away from U.S. treasuries and into gold, driven by sanctions and the weaponization of the financial system. It's not a sudden collapse. It's little by little, then all at once. That's how reserve regimes shift. And when money loses its unquestioned status, metals don't rise because they're trendy. They rise because they're neutral. Now we're at the part where the future splits into paths, and neither one is comfortable. Because when silver breaks $100 in this kind of environment, it's no longer just a commodity move. It becomes a directional signal. The market is preparing for instability, and it's doing it with size. Path 1 is continuation through momentum. In this version, physical scarcity stays acute, retail demand stays irrational, and global premiums keep pulling metal away from weaker hands. The projections people whisper about, $150, even $200, stop sounding like fantasy and start sounding like checkpoints. Not because someone predicts them, but because the market is behaving like resistance is optional. Path 2 is disruption through stress. Refiners extend delays. Dealers lose the ability to recycle inventory. The gap between paper price and real-world availability widens. And the market doesn't correct downward. It fragments upward. The price becomes less about valuation and more about access. But here's the detail that makes this unstable. Gold is running to, approaching $5,000 in the same narrative framework. And when both metals move together like this, the story isn't growth. So the question isn't whether prices will be volatile. That's already happening. The real question is what the next catalyst will be, because the next move is already forming, somewhere you're not looking yet. Here's the takeaway you're going to remember long after the price chart changes. Silver didn't break $100 because the world got richer. It broke $100 because the old system of restraint is failing. When a market stops consolidating at psychological levels, when the supply chain can't process enough metal to keep shelves stocked, when retail demand increases with price instead of falling, and when the short side refuses to step in. That's not a normal breakout. That's a regime shift. The pricing mechanism detaches from the story we're used to telling ourselves. And that's why this moment matters. Not because silver is up, but because the rules that used to cap it, liquidity, processing capacity, resistance, suppression, are visibly weakening at the same time. Once those rules crack, the numbers stop being ceilings. They become stepping stones. So if you want to understand what comes next, don't just watch the metal. Watch the plumbing behind it. Watch who can still deliver. Watch who stops selling. Watch which market leads and which one chases. And if you want more analysis like this, clear, fast, and grounded in the mechanics, make sure you follow and subscribe. Because the next phase of this story won't start at 100. It'll start when something else snaps.